Have you ever wondered just how safe your money is in the bank? You probably know about FDIC insurance, that sticker on the bank door promising your deposits are protected up to $250,000. But what happens when a bank truly gets into trouble? What you might not know is that there's a quiet, almost invisible process where the federal government can step in long before the headlines hit. This isn't a conspiracy theory, it's a fundamental part of our banking regulation, designed to prevent collapses and protect the entire financial system. Today, we're pulling back the curtain on this process of quiet federal control and what it really means for you, the depositor. So let's start with the basics. Banks don't just operate on their own. They're watched over by several federal agencies, like the Federal Reserve, the Office of the Comptroller of the Currency, or OCC, and of course, the FDIC. These aren't just passive observers. They're constantly monitoring a bank's health. They look at things like how much cash a bank has on hand, the quality of its loans, and its overall risk management. Think of it like a regular health checkup for the bank. Most of the time, the bank gets a clean bill of health and everything continues as normal. But what if the checkup reveals a problem? What if a bank has been making too many risky loans that are starting to go bad? Or maybe it doesn't have enough capital, which is like its own safety cushion of money. This is where quiet intervention begins. The regulators won't make a big public announcement. That would cause a panic, right? Imagine seeing a headline that says your bank might be in trouble. Everyone would rush to pull their money out, creating a bank run that could kill even a healthy bank. Instead, the process is discreet. It starts with what are called matters requiring attention, or MRAs. The regulator will privately tell the bank's management, hey, we've noticed these specific issues and you need to fix them. This is the first formal warning shot. The bank is then required to submit a detailed plan on how it will correct the problems. Maybe they need to raise more capital, sell off some risky assets, or fire the managers who made the bad decisions. If the bank doesn't fix the issues, or if the problems get worse, the regulators escalate their actions. This can lead to a formal, legally binding agreement, like a consent order. This isn't just a suggestion anymore, it's a command. The bank must agree to take specific actions by certain deadlines. These orders can be very restrictive. They might prohibit the bank from paying dividends to its shareholders, limit the salaries of its executives, or even require the bank to find a buyer and merge with a stronger institution. All of this is still happening largely behind the scenes. While these consent orders are technically public documents, they are buried in regulatory websites and written in dense legal language. The average person isn't going to stumble across them. The goal is always to resolve the problem without causing a public panic. The regulators and the bank work together, often under intense pressure, to steer the ship back to safety before it hits an iceberg. So what does this mean for you as a depositor with money in that bank? Well, during this quiet control phase, your experience should be completely normal. You can still use your debit card, write checks, access your online banking, and talk to the tellers. The ATMs will work, and your direct deposits will arrive on time. From your perspective, it's business as usual. The entire point of this quiet process is to ensure that your day-to-day banking is never disrupted. The battle to save the bank is happening in the boardrooms and with the regulators, not at the teller window. Your money is also still protected by FDIC insurance. This is the ultimate safety net. Even if the regulators' efforts fail and the bank eventually does collapse, the FDIC will step in to make you whole, up to the $250,000 limit. Usually, what happens is the FDIC arranges for another healthy bank to acquire the failed bank over a weekend. So, on Friday, you're a customer of Bank A, and by Monday morning, you're a customer of Bank B, with full access to all your funds. The transition is designed to be seamless. Now, you might be thinking, this sounds a bit sneaky. Why isn't this more transparent? It's a valid question. The reason for the secrecy is simple: confidence. The entire banking system runs on confidence. We deposit our money because we have faith that we can get it back when we need it. If that confidence shatters, the system freezes. By handling these issues quietly, regulators prevent widespread panic that could cause a chain reaction, toppling other healthy banks in a domino effect. They are trying to perform surgery on one part of the financial body without alarming the rest of it. Think about the failure of Silicon Valley Bank in 2023. Even though regulators were working with them behind the scenes, news of their trouble leaked out. And a bank run fueled by social media and tech industry group chats brought them down in less than 48 hours. It's a powerful example of why regulators prefer to keep things quiet. A loss of confidence can be fatal, so the quiet control is actually a feature, not a bug, of our banking system. It's a proactive, preventative measure. It allows experts to fix problems before they become catastrophes. For depositors, it means that by the time you ever hear about a bank being in serious trouble, the situation is usually either being resolved or a plan is already in place to protect you. Does this mean you shouldn't pay attention to your bank's health? Not at all. While you don't need to panic, being informed is always a good idea. You can look up your bank's Texas ratio. a simple metric that compares a bank's troubled loans to its capital. A ratio above 100% can be a red flag. You can also check for any public enforcement actions on the FDIC or OCC websites, if you're willing to do some digging. But for the vast majority of people, the most important thing is simply to ensure your deposits are within the FDIC insurance limits. If you have more than $250,000 at a single bank, you might want to consider spreading it across different banks to ensure all your money is fully protected. FDIC insurance is the ultimate guarantee. It's the government's promise that even if all the quiet interventions fail, your insured money is safe. In the end, the system of quiet federal control is a delicate balancing act. It balances the need for regulatory oversight with the need to maintain public confidence. It's a system designed to work in the background, to be the silent guardian of your deposits. It ensures that the financial plumbing of our country keeps flowing smoothly, so you can go about your life without worrying if your bank will be open tomorrow. It's not about hiding the truth from you. It's about fixing the problem before it ever becomes your problem. Thank you so much for watching. I hope this gave you a better understanding of how the banking system really works behind the scenes. If you found this video helpful, please give it a thumbs up. And don't forget to subscribe for more insights into the world of finance. Let me know your thoughts in the comments below. See you in the next one. There is a continuum in bank supervision. On one end, normal operations. On the other, full receivership where shareholders are wiped out and assets are sold. In between sits a gray zone, consent orders, supervisory agreements. Valley National Bancorp, significant exposure to urban multifamily properties, rising loan loss provisions, share buybacks halted, earnings calls heavy with defensive language, and then there's Flagstar Bank, absorbed into a larger entity in what was presented as strategic growth. Yet the combined balance sheet amplified real estate risk at a fragile moment. None of these institutions have been publicly seized, but the signals align with enhanced supervisory oversight. And here's the psychological layer most people miss: normalcy bias. We assume tomorrow will resemble yesterday. If our debit card works, the bank must be fine. If the branch is open, stability must exist. Banks understand this. Regulators rely on it. Because confidence buys time. Yet time doesn't erase mismatched math. Commercial real estate values in many metropolitan areas have fallen 20 to 40% from peak levels. Loans made during euphoric years are maturing now. When borrowers cannot refinance, losses crystallize. Accounting rules allow banks to delay recognition temporarily, but maturity dates cannot be postponed forever. Picture a dam with hairline cracks. Water pressure builds slowly. From a distance, it looks solid. But internally, strain accumulates. Most people never hear the next part, and that's the real danger. Because in part 3, we confront the question no depositor wants to ask. What happens to your money if containment fails, and how do you protect yourself before headlines break? Let's bring this down to something personal. Imagine you run a small manufacturing business. Payroll hits every Friday. Vendors expect payment. You keep $800,000 in a single regional bank because it's convenient. It's local. It's familiar. Technically, only $250,000 is insured under FDIC rules per ownership category. The rest, uninsured. That doesn't mean guaranteed loss, but it does mean exposure. If regulators transition from quiet supervision to formal receivership, access to funds above insured limits can freeze while resolution unfolds. Even insured balances may take a short period to become accessible. For a household, that's stressful. For a business, it can be catastrophic. In extreme scenarios, uninsured deposits can be converted into equity under modern resolution frameworks. That means your cash becomes shares in a struggling institution. It sounds dramatic, but similar mechanisms have been used internationally. So what do? First, audit your exposure. Know exactly how much you hold at each bank. Diversification isn't paranoia, it's risk management. Second, understand alternatives. Short-term U.S. Treasury bills and Treasury-focused money market funds carry direct government backing. They don't depend on a bank's commercial real estate portfolio performing well. Third, monitor signals. Read earnings reports. Pay attention to supervisory disclosures. Watch capital ratios and loan concentrations. Not obsessively, intelligently. We are late in a credit cycle that began after 2009, when near zero interest rates encouraged aggressive lending. The assumption was simple. Rates would remain low, property values would rise, growth would continue. Those assumptions shifted. Interest rates climbed rapidly. Property demand changed. Remote work reshaped office markets. Retail corridors emptied. Banks that concentrated heavily in those sectors now face structural headwinds. Regulators are unlikely to close dozens of institutions simultaneously. The Deposit Insurance Fund, managed by the Federal Deposit Insurance Corporation, is designed for orderly resolution, not mass panic. So management happens in phases, quietly, methodically. The question is not whether the entire system collapses. It likely won't. The question is whether specific institutions absorb disproportionate damage. Financial history teaches a consistent lesson. The earliest signals are subtle. The official confirmation arrives last. Confidence is powerful, but blind confidence is dangerous. There's no need for panic. Panic destroys judgment. There's a need for awareness. If your deposits exceed insured thresholds, reassess. If your bank shows multiple distress indicators, reconsider. If your financial strategy assumes perpetual stability, revise it. Because risk rarely announces itself loudly. It whispers first. And this is where everything becomes clear. Systemic stability does not guarantee individual protection. You must position yourself on the right side of asymmetric risk. Preserve capital first. Seek return second. That mindset separated those who survived previous cycles from those who were blindsided. Now I want to hear from you. Are you holding more than $250,000 in a single institution? Do you feel confident in your bank's exposure profile? Or are you reconsidering your strategy? Drop your thoughts below. If this breakdown gave you clarity, not fear but clarity, then subscribe to Economic Tales. This channel exists for one reason: to decode financial signals before they become headlines. Share this with anyone running a business or holding significant deposits in regional banks, because by the time the announcement comes on a quiet Friday evening, decisions are no longer yours to make. Stay sharp, stay informed, stay ahead. I'll see you in the next one.